Denmark's personal income tax system is often cited as one of the most progressive and comprehensive in the world, and today we will explore how it works in practice and how it compares with other European countries. To set the stage, it is important to understand that Denmark combines relatively high tax rates with a strong social safety net, universal welfare services, and a high level of trust in public institutions. This configuration shapes not only the structure of the personal income tax system, but also how Danes perceive the value they receive in return for what they pay. When we talk about personal income tax in Denmark, we are really referring to a layered structure that includes state tax, municipal tax, labor market contributions, and in some cases, additional top bracket taxes. At the core is a progressive state income tax, with marginal rates that increase as income rises. This is complemented by municipal taxes, which are set by local authorities within a regulated range and applied at relatively flat rates, and by mandatory labor market contributions that finance key employment-related benefits. In recent years, the combined top marginal tax rate on personal income in Denmark has typically been just below 56% when all components are included, placing it among the highest in Europe. However, focusing exclusively on the top rate can be misleading, because the effective tax burden varies significantly across income levels, and because the system incorporates a range of deductions, allowances, and thresholds that alter what people actually pay. For low and middle income earners, Denmark provides personal allowances that reduce taxable income, meaning that individuals pay no or relatively little tax on the initial portion of their earnings. As income rises, taxpayers move through progressively higher brackets, with marginal rates increasing while the tax-free allowance remains constant, thereby creating a smoothly increasing effective tax rate. The progressivity is further reinforced by the structure of social contributions. Unlike in many European countries where social security contributions can be both high and regressive, capped at certain income levels and falling more heavily on low and middle earners, Denmark's labor market contribution is a relatively flat percentage, but it is integrated into a broader system where high personal income taxes shoulder much of the redistribution. When we compare Denmark with other European countries, three dimensions are particularly relevant: marginal tax rates, effective tax burdens, and the relationship between taxes and public services. On marginal rates, Denmark is at the higher end of the spectrum. Countries like Sweden, Belgium, and France also have high top marginal rates, often in the 50% range. But Denmark consistently ranks among the top few. By contrast, countries such as Ireland, the United Kingdom, and many Central and Eastern European states maintain lower top marginal rates, sometimes between 20 and 35%, though these often sit alongside separate social contributions and indirect taxes that increase the overall fiscal burden in less transparent ways. In terms of progressivity, Denmark's system is more steeply graduated than many European peers. Some countries operate with a large number of tax brackets, but relatively modest differences between them, resulting in a system that is progressive in name but moderate in effect. Others employ flat taxes or near-flat schedules that keep marginal rates constant above a low threshold, which simplifies administration but offers limited redistribution. Denmark, by contrast, leans explicitly into redistribution, using higher marginal rates at the top to fund universal benefits, including healthcare, education, childcare, and income support programs. That universal character is crucial. While the tax burden on higher earners is substantial, access to public services does not depend on income, which reinforces a sense of collective investment rather than targeted transfer. When we look at effective tax rates, the share of income actually paid in tax after allowances and deductions, Denmark again positions itself near the top, but the gap with other high-tax European countries narrows. For a median income worker, the effective rate in Denmark is broadly comparable to levels seen in countries such as Germany, Finland, or the Netherlands, once social security contributions and payroll taxes are fully accounted for. In many of these peers, headline income tax rates appear lower, but employees and employers pay sizable mandatory social contributions, sometimes on a regressive basis and often with caps that reduce the marginal burden on high earners. Denmark's model consolidates much of this into the personal income tax system itself. making the structure more transparent and arguably more progressive, even if the headline figures seem high. Another distinguishing feature is how Denmark balances income taxation with indirect taxes such as value-added tax and excise duties. Denmark applies one of the higher standard VAT rates in Europe, which is regressive by nature, since lower-income households spend a greater share of their income on consumption. However, this is partially offset by the progressivity of the income tax system and by the scale of cash transfers and in-kind benefits available to lower and middle-income households. In comparison, several European countries with lower income tax rates rely heavily on consumption taxes or on employer-side contributions that are less visible to employees, resulting in a fiscal mix that may feel less progressive in practice. From an economic perspective, one frequent concern with highly progressive tax systems is their potential impact on labor supply, talent attraction, and entrepreneurship. Denmark's experience offers a nuanced picture. On the one hand, the high marginal tax rates at upper income levels do reduce the after-tax returns to additional work or investment, which can influence decisions around overtime, career progression, or location choices for highly mobile professionals. A number of other European countries attempt to address this with special tax regimes for skilled foreign workers or returning expatriates, and Denmark has deployed similar tools, offering time-limited reduced tax rates to attract international talent in key sectors. On the other hand, Denmark benefits from a strong social contract that supports labor mobility and risk-taking. With universal healthcare, subsidized education, and robust unemployment insurance, individuals face lower personal risk when changing jobs, starting businesses, or retraining. This flexicurity model, combining labor market flexibility with social security, relies heavily on the revenue generated by personal income taxes. In comparative studies, Denmark continues to score highly on measures of competitiveness, innovation, and ease of doing business despite its high tax levels, suggesting that the overall system design and institutional quality can mitigate some of the disincentive effects commonly associated with progressive taxation. Looking across Europe, we see a spectrum of models. At one end, countries like Denmark and Sweden prioritize universal welfare, funded by relatively high progressive income taxes, combined with broad-based consumption taxes. In the middle, countries such as Germany, France, and Italy mix income tax progressivity with substantial and often complex social security contributions that split between employers and employees. At the other end, several Central and Eastern European economies, as well as a few Western outliers, emphasize lower and flatter income tax structures, relying on a combination of indirect taxes, social contributions, and narrower public service provision. Denmark stands out as a clear benchmark for the high-tax, high-service approach, and the performance of its economy, social outcomes, and governance offers a reference point for policymakers, considering the trade-offs between equity, efficiency, and simplicity. For individuals and businesses operating in or with Denmark, understanding this tax model is essential. It implies that gross salaries at higher levels need to be calibrated carefully to remain competitive after tax, and that total compensation should be considered alongside the value of public services employees receive. For policymakers in other countries, Denmark's experience illustrates both the potential benefits and the political prerequisites of a progressive system. Sustained public trust, consistent policy over time, and clear communication about the link between what is paid in tax and what is provided in return. As debates about inequality, fiscal sustainability, and social cohesion continue across Europe, Denmark's personal income tax system will remain a key reference in discussions about how to design progressive, transparent, and effective tax regimes.